Have you ever tracked a package online? Watched it move from place to place?
Oh, yeah, definitely. Or just seeing those huge trucks on a highway.
Exactly. And you kind of wonder, just for a second, what's the huge, complex dance going on behind it all? Getting everything we buy, everything we use from A to B.
It's way more intricate than most people probably think, and honestly, pretty fascinating.
Welcome to the deep dive. So today we're peeling back the layers on freight transportation. Specifically, we're looking at XPO's recent second quarter 2025 results.
Right. And our mission here is basically to cut through all the numbers, the jargon,
Yeah, strip it down.
and give you a really clear picture of how a major player, a really big player in this essential industry is doing. Not just getting by, but actually doing well in the current economy.
And how they're setting themselves up for, well, whatever comes next.
And look, why this matters to you is, well, it's pretty profound, actually.
Yep.
We're going to uncover some surprising things about how tech, especially AI, is making shipping, way more efficient.
Right.
You'll see how these giant companies adapt when the freight market gets shaky and what all these big moves mean for the economy overall, maybe even the prices you pay.
And how fast that package gets to your door.
Exactly.
Yeah.
Get ready for some real aha moments about how commerce actually works behind the scenes.
Okay, so let's dive in. Our sources are showing that XPO described the market as having a soft rate environment.
Which is basically industry code for things are tough, rates are low.
Right. But despite that, they reported genuinely strong results for Q2 2025. That really jumped out at me.
Yeah, and what's really striking is the context. They're putting up these numbers during what the industry calls the trough of the cycle.
So like the bottom.
Pretty much the bottom, yeah. Industry volumes are struggling. Yet XPO's total revenue was, $2.1 billion? Basically flat compared to last year.
Flat sounds okay, but maybe not amazing.
Well, hold on. Their adjusted EBITDA, that's a key profit measure, right? Before all the interest, taxes stuff.
Got it. Core operational profit.
Exactly. That hit $340 million.
Mm.
Okay, was down slightly. Less than 1% year over year. But, and this is the crucial part, it beat expectations.
Ah, okay. So analysts thought it would be lower.
Way lower, potentially. Yeah. And their adjusted diluted earnings per share, basically profit per share of stock, came in at $1.05. Also beat expectations.
So it's a signal their underlying business is really holding up, even when the market's down.
Very strong signal, yeah.
Okay, so if the overall market is tough, but their numbers are strong, where's this outperformance coming from? Is one part of the business really, carrying the weight?
Absolutely. And this is where it gets really interesting. A huge chunk of this success comes squarely from their North American less-than-truckload business.
LTL.
LTL, right. Less than truckload, so not full trucks, but consolidated shipments.
Precisely. And their LTL business isn't just doing well, it's genuinely outperforming the rest of the industry. That's what everyone's pointing to. Okay, outperforming the industry is a big claim. What specifics back that up? What are the metrics showing they're actually leading, not just, keeping up?
Well, get this. Their adjusted operating ratio was 82.9%.
Okay, break that down. What does 82.9% mean in simple terms?
It means for every dollar they bring in, they're spending about 83 cents to run the operation. It's a measure of efficiency. Lower is better.
And 82.9 is that good?
It's very good.
Yeah.
But here's the kicker. They improved it by 30 basis points. That's 0.3% compared to last year.
In this market.
In this market. And apparently they are the only major public LTL company to actually expand their margins year over year.
Wow. Okay, so they're running tighter ships than anyone else right now.
That's exactly what it suggests. Incredible cost control, efficient operations, making every truck, every facility work smarter.
But it can't just be about cutting costs, can it? Are they also getting better prices for their services?
They are. That's the other side of the coin. Their yield, think of that as the revenue per pound of freight, basically excluding fuel, jumped 6.1% year over year.
6% is pretty solid growth.
Especially now. And it grew sequentially from Q1. Plus, their revenue per shipment was up 5.6% year over year. And get this. It's the 10th quarter in a row they've increased that sequentially.
10th quarter. Wow. So consistent price increases quarter after quarter, even when the market's soft. How are they pulling that off? What's the secret sauce there?
Well, according to them, it boils down to superior service. That's what they're attributing the pricing power to.
Superior service. Okay,
Well, for example, their damage claims ratio.
Yeah.
How often stuff gets broken. It improved again year over year and hit a crazy low 0.3%.
0.3%. So almost nothing gets damaged.
Practically nothing. And their on-time performance, this is the 13th straight quarter they've improved that year over year.
13 quarters of getting better at being on time. That's impressive consistency.
It really is.
Yeah.
And it kind of raises that interesting question, right? In an industry that can be so focused on just the lowest price, can genuinely better service translate into higher prices and winning more business?
It seems like XPO is making a strong case that it can, because our sources show they are gaining profitable market share, even if their overall volume is slightly down.
Right. The total tonnage per day was down about 6.7%. Shipments per day down 5.1%.
Which sounds bad initially.
They're growing significantly in areas like local channel shipments, think shorter, potentially higher margin routes. Those were up high single digits.
Ah, so they're being selective, prioritizing the good revenue, the profitable loads, over just filling trucks at any cost.
Precisely. It's a strategic focus on value, not just volume. Especially smart in a down market.
Okay, but does focusing on high-margin stuff now risk them being unprepared if or when the market suddenly booms again? Could competitors who just chased volume catch up?
That's a really good question, and it actually leads right into their next big strategy.
Right.
Because instead of pulling back like you might expect in a soft market,
They're investing.
they're investing heavily, making a big bet on the future, specifically in their network and their fleet. Since they started this big LTL growth plan back in 2021, they've added almost 6,000 new tractors
Wow.
and over 17,000 trailers.
That's a lot of new equipment.
It means their average tractor is now less than 4 years old. Think about that: super reliable, much lower maintenance costs. In fact, their maintenance cost per mile dropped 6%.
Like having a new car versus a 10-year-old one. Fewer breakdowns, cheaper to run.
Exactly. And it's not just trucks. They're investing in real estate too, opening some huge new LTL service centers.
Like hubs.
Yeah, including 2 massive new break bulk facilities, one in Carlisle, Pennsylvania, another in Greensboro, North Carolina.
Key locations, right? Major freight corridors.
Absolutely. Think of these break bulks as super efficient sorting centers. They let XPO run more direct loads, which means fewer rehandles.
Less moving packages between trucks.
Exactly. Fewer rehandles means less chance of damage, faster transit times. It all ties back to that superior service idea.
Okay, that makes sense. Investing in efficiency and service quality simultaneously.
And here's the really forward-thinking part. They've intentionally built up about 30% excess door capacity across their network.
30% extra space. Why?
So when the market does turn around and freight volumes surge,
They're ready. While everyone else is scrambling for space.
bingo, they can just open the doors, absorb the new business instantly, scale up smoothly. It's a massive potential advantage.
Playing the long game. That's smart.
And speaking of smart, the technology piece here is, well, it's really fascinating how deeply they're embedding tech and AI into everything.
Right. You mentioned AI earlier. How are they using it?
Okay, so they have this proprietary labor planning tool. It gives their managers real-time visibility into how much freight is flowing through a terminal.
So they know exactly how busy they are, moment to moment.
Pretty much.
Yeah.
Which lets them adjust staffing perfectly to match demand. No wasted hours, no being short-staffed. And it showed results. They actually improved their labor hours per shipment in Q2 because of this.
Okay, that's clever efficiency. What else?
It gets more advanced. They're using AI-powered models for their line haul routes, the long-haul trek movements between cities.
And that's saving money.
Big time. They've cut their normalized line haul miles by 3%. They've reduced empty miles trucks driving with nothing in them by over 10%.
10% fewer empty trucks. That's huge for fuel and costs.
Massive.
Yeah.
And they cut freight diversions, basically trucks taking inefficient routes, by over 80%. 80%.
Yeah. So the AI is optimizing routes in ways humans probably couldn't even see?
It seems so. And they're not stopping there. They're now piloting AI in the local pickup and delivery side of things, P&D.
The final mile stuff.
Yeah. And they're seeing, quote, early encouraging results. Things like more stops per hour, better use of trailer space.
So it seems like AI is becoming a real competitive edge for them, not just a buzzword.
It absolutely looks that way. And it's not just about saving money, right? It ties back to service. Less damage, faster transit, more reliable pickups. It all reinforces that premium service they're selling.
Which lets them charge more. It all connects.
Exactly. It really makes you wonder, how much further can this go? How will AI fundamentally change how everything moves around the globe?
A question for the future, maybe. But okay, shifting gears slightly, it wasn't just the North American LTL doing well, right? What about their European operations?
Right, good point. Their European transportation segment also showed remarkable resilience,
Hmm.
especially given what they called a tough macro backdrop over there.
So economic headwinds in Europe, too.
Yeah. But despite that, their European revenue actually grew 4% year over year, and their adjusted EBITDA jumped 38% just from Q1 to Q2.
38% sequential growth. That's huge.
Way ahead of what you'd normally expect just from seasonality. And they managed to grow profits year over year in key places like the UK and Central Europe.
So it shows they're not just a one-trick pony with the U.S. LTL. They have operational strength across different regions.
Definitely. It gives them that diversification, a bit of a shock absorber if one market gets particularly rough.
And are they finding new ways to grow beyond just optimizing the current business?
They are. They're actively looking for new, attractive markets.
Like what?
Well, one specific example they mention is this new grocery consolidation service.
Grocery consolidation. What's that?
Basically, picture lots of different food suppliers sending small shipments to a grocery chain's distribution center. XPO steps in, collects all those smaller shipments near the suppliers, combines them into efficient, full truckloads.
And then delivers the full truck, making it simpler for the grocery store.
Exactly. More efficient for the grocer, potentially lower costs. XPO sees this as about a billion-dollar market opportunity.
$1 billion.
Yeah, and they think it has good profit margins. They admit they're currently sort of underrepresented there, but they plan to ramp up significantly in the next few months.
Leveraging their network and service reputation to grab a piece of that pie.
That seems to be the plan. Plus, they're also seeing more demand for what they call premium services.
Okay, what falls under premium? Faster shipping, special handling.
Things like that, yeah. Expedited options, liftgate services, maybe temperature control. And they're also gaining more business from local accounts, which tend to be higher margin.
So more add-on services, more specialized stuff.
Right. And that shows up in their accessorial revenue.
Yeah.
That's the money from these extra services. Used to be maybe 9–10% of their total revenue.
And now?
Now it's a couple of points higher, and they're aiming for 15% eventually. They see a long runway there.
So another clear path to keep improving their yield and profitability.
Seems like it. Adding more value, charging for that value.
Okay, all these operational improvements, the investments, the new services, it all sounds great. But it costs money. How's their actual financial health looking? Can they support all this?
Yeah, that's the crucial underpinning, isn't it? And they look very solid on that front. They generated $247 million in cash just from their operations in Q2.
Nearly $250 million in cash flow in 3 months? That's strong.
Very strong. And their overall liquidity cash on hand, plus what they can borrow, easily ended the quarter at $824 million.
So plenty of financial flexibility, a good safety net, and money to keep investing or, weather any storms.
Precisely. And they're signaling they'll be smart about spending going forward, too. They expect their capital expenditures, CapEx, the spending on trucks, buildings, etc., to actually moderate a bit in the future.
So the big investment push might be easing off.
Seems like it. Which means more of their earnings should convert directly into free cash flow, basically, usable cash after investments. Their full-year CapEx forecast is between $600 and $700 million.
Okay, so maybe less spending on assets, more cash building up. What do they plan to do with that?
Well, returning some of it to shareholders is one thing. Their debt levels look healthy. The net debt leverage ratio improved to 2.5 times.
Lower debt is good.
Always. And they've started buying back their own stock, repurchased $10 million worth in Q2, and they plan to do more as free cash flow grows.
Returning value to investors.
And they're also paying down debt proactively. They paid off $50 million in July, just after the quarter ended.
Sounds like prudent financial management.
It does. And there's one more kicker for their cash position, a tax benefit.
Oh, yeah?
Remember that one big, beautiful bill act they mentioned, signed July 4th?
Vaguely. What did it do?
Well, for companies like XPO, it brought in 100% bonus depreciation and lets them immediately expense R&D costs.
Okay, translate the tax speak. What does that mean for their cash?
It means when they buy new trucks or invest in that AI research, they can deduct the entire cost from their taxable income right away in year one, instead of spreading that deduction over many years.
So bigger tax savings now.
Much bigger tax savings now, which means a significant boost to their current cash flow. It's a pretty big deal for them.
Okay, so operationally strong, financially solid, getting a tax boost. How are they feeling about the near future? What's the outlook?
They seem very confident, actually. Looking ahead to Q3, they expect their adjusted operating ratio to be pretty similar to Q2.
Staying flat sounds okay.
It's actually much better than okay, because normally Q3 is seasonally worse for LTL operating ratios. Usually it increases by maybe 200 to 250 basis points.
So staying flat when it normally gets worse is actually strong outperformance relative to the typical seasonal pattern.
Exactly. It shows those operational improvements are really sticking, counteracting the usual seasonal pressures.
And for the full year?
Well, they still expect overall industry tonnage to be down maybe mid-single digits. But even with that backdrop, they expect to improve their own operating ratio by about 100 basis points, or 1%, for the full year compared to last year.
Improving margins even while the market shrinks. That's impressive.
It is, and they sound, quote, incredibly excited for when the freight market eventually recovers.
You can see why based on these numbers.
Yeah, when the upcycle hits, they're projecting what they call incremental margins to be comfortably over 40%.
Incremental margins, meaning the profit on new business.
Exactly. So when volumes start really picking up again, for every extra dollar of revenue they bring in, more than 40 cents will drop straight to the bottom line as profit.
That's powerful leverage for growth.
Extremely powerful. For context, the last time they had revenue growth, back in Q4 2024, their incrementals were apparently 70%.
70%, wow.
So that 40% plus projection might even be conservative. And they see it coming from continued yield growth above the market rate, less reliance on expensive third-party transportation because they've invested in their own fleet.
Right, bringing it in-house saves money.
And all those AI initiatives kicking in and accelerated productivity gains.
So it really sounds like they've positioned themselves to hit the ground running when things pick up.
That's clearly the goal. Oh, and one last point on the competitive landscape. They mentioned the potential separation of FedEx's freight business.
Right, FedEx Freight potentially becoming its own company. How do they view that as a threat?
Interestingly, no. They actually see it as potentially good for the industry overall.
Good. Why?
Their thinking seems to be that a more focused, standalone FedEx Freight might put even more emphasis on price discipline and improving its own margins.
So if a giant like FedEx Freight focuses more on profit over just volume, it kind of lifts the standards for everyone, discourages price wars.
That seems to be the idea. It could lead to a more rational, perhaps more profitable competitive environment for all the major LTL players.
Interesting perspective. Okay, so let's recap then. We've really unpacked XPO's Q2 here. We've seen how this disciplined focus on service quality.
Backed up by those strategic investments in their network, their trucks, their tech.
Right, and that groundbreaking use of AI, it seems. It's all driving this outperformance.
Yeah, they're not just sort of treading water in a weak market. They're actively improving their efficiency, their margins.
Expanding into new areas like grocery.
And getting everything perfectly tuned, it feels like, to just accelerate profit when the market finally turns positive again.
So what does this all really mean for you listening?
Well, it means that even in these huge, maybe sometimes invisible, backbone industries like freight, there are companies finding really smart, innovative ways to get better.
And their success or struggles directly impacts, how quickly you get stuff, how much it costs, the whole flow of the economy, really.
It really does shape the arteries of commerce.
So here's something to think about, a final thought. As AI gets deeper and deeper into logistics, not just tracking, but predicting demand, optimizing every single route, maybe even managing fleets semi-autonomously, how is that going to fundamentally change how goods move?
What new opportunities does that create? Or what new challenges for businesses, for us as consumers? Could we see totally new kinds of delivery systems we haven't even imagined yet?
Something to definitely mull over until our next deep dive.